2023 has been a challenging year for microcap stock investors, so I'm really excited today to bring you a stock that's up 92% year to date. But not only that, it's got a lot more potential, a lot more room to grow in the future. Today, I'm looking at Enterprise Group Inc. Let's get started. My last video on Enterprise Group, I will link down below in the pinned comment. They were trading at around 43 cents. And this company really got my attention with a low trailing PDE, a low price to sales, a low float, and all of this on 31% quarterly revenue growth, gross profit, and massive EBITDA for such a small company. With with a lot of colors that I like, including green bars revenue going up year after year, blue bars earnings going up year after year. I mean, come on, we need to look at this one. And my investing thesis, which really hasn't changed, is that as you could see right before COVID, 2020, March 31st, this company was doing quite well and on the way up when all of a sudden COVID hits. This is an oil and gas servicing stock. It really had trouble through COVID. Up, down, up, down, up, down, profitable, unprofitable. It was all over the place. However, in 2023, in a year when a lot of microcaps struggled, this was the year when this company could really take off. And as always, do not forget it's easier for good microcap companies to take advantage of good market conditions for them because they're in oil and gas, right? When you have a good financial foundation. And Enterprise Group assets over liabilities was impressive. So, just a quick look at what they do before I get into their numbers. They are on Canada's main exchange, the TSX. They are also listed in the US on the OTCQB. They are talking about growth, new avenues for growth for this company. But in the meantime, as they are cash positive, they have purchased back nearly 11 million shares since the start. So a lot of things to like here. Multiple streams of revenue that are a bit too complicated to cover in this earnings video. Please go have a look at their website. But very quickly, the meat and potatoes of their revenue is renting out equipment to oil and gas companies, innovative mobile power solutions for large oil and gas companies, transitioning natural gas to electricity in remote locations. They bring clean, cost efficient, and reliable power to places that normally struggle to do this. When a small company, when a microcap company can solve a problem for multi billion-dollar oil and gas companies, that's a revenue stream I can get behind. 3 and 9 months ended September 30th for Enterprise Group. Let's go have a look. I mean, just looking at the 9 month, this is impressive, right? Revenue is up, gross margin is up 45%, adjusted EBITDA up 37%, net income is way up 3.9 million, up from 487,000. 8 cents per share earnings. And this isn't going down in the quarter, right? The 3 months, September 30th, revenue up, margins are even better, up to 46%, adjusted EBITDA up to 40%. Each quarter, they're improving. Net income is wonderful. For the 9 months ended September 30th, the company generated cash flow from operations of $10.5 million. That's impressive. In a challenging year for a lot of microcaps, this company is just running away with it. In a weird twist of things you don't see very often, the company in the past 9 months has repurchased and canceled 1.2 million shares, a total of 11.3 million shares since inception. But on top of that, they actually have some debt and they recently extended their bank loan here for an additional year. Their loan now expires on September 29th, 2025, and there's no penalties for doing that. They have an interest rate of 10.5%. So let's go look at how much debt they have and why they're buying back shares. Expenses are actually down a bit, which is kind of nice. Their finance expenses are not, and it's down here, right? So they increased their expenses on long-term debt, which increased from 352,000 to 456,000. So that's of course that 10.5% refinancing of their debt. I'm assuming as interest rates go up, the payments on debt get higher. Some just stunningly number improvements here from last year, right? Gross margin is up what? Nearly $4 million. Income before financing and taxes is up just about the same, right? $3.5 million, a little bit more. And then net income here going from a little under $500,000 to almost $4 million. Lots to like. And if that isn't enough, for people who hate share dilution, total common shares outstanding going down, share buybacks, people. Gotta love that. On top of that, total assets increasing significantly from last year, up $12.6 million. That's fantastic, though. Weirdly enough, total liabilities up as well. So go figure. All important cash flow, net cash provided by operating activities. Look at this number, $10.5 million, up from $5.1 million last year. That is impressive. Cash and cash equivalents at the end of the period, though, only 1.57 million. And you wonder why? That's because of this huge number right here, net cash used in investing activities. What did they spend this cash on? Well, it wasn't paying down debt. They paid down $406,000 in debt. They spent $508,000 in buying shares back. They actually used the cash in investing activities. $10.4 million paid to purchase property, plant, and equipment, and $765,000 of cash received from the sale of equipment. So please do not forget, this is a company that rents out equipment to large oil and gas manufacturers. So this is basically buying equipment, property, plant, and equipment that they can get revenue from in the future by renting it out. The greater services they could provide, the more money they can make in the future. This is investing into themselves. So I have to stop here and point out some impressive assets. So, I mean, we've got cash, we've got trade and receivables, we've got unbilled revenue, we've got deposits and prepaid expenses. So these $10.5 million in assets are really good assets, basically revenue coming and cash. And because these are oil and gas companies, they'll probably get this revenue. The other thing is property, plant, and equipment, 49.7 million. Tiny little bit of goodwill, tiny little bit of intangible assets. So I don't know how many crappy companies I've covered this year where most of their assets is goodwill and intangibles. And I've said before, poof, magical assets that can disappear. This company, Enterprise Group, has good, solid assets, meaningful assets. I like that. And when I talk about this company reinvesting into themselves, you could see that right here. Heavy automotive construction and portable rental equipment started out in 2022 at $67 million. We have additions, we have disposables, and we have reclass. At the end of the day, they now have $76.8 million of heavy automotive construction and portable rental equipment to again make revenue from. Simple share structure, nothing complicated, which I love. Common shares outstanding, stock options outstanding, only 5.1 million. Very low float, very low options out there. Like it, love it. Gotta love that. Can't complain. Only thing, only thing I could complain about on these earnings, most of my videos, I have a green flags why I would invest in a company, and then I have a red flags why I wouldn't invest in this company. I was worried that I wasn't going to have any red flags on Enterprise Group. The only thing I found here is that the company generated 44% of their revenue from two customers. So, I mean, there is some risk here. Something happens, a customer goes away, that's a lot of revenue dropped. Like, we're not talking about a trickle down in share price, we're talking about a crash. So this is a risk. And maybe we could add the debt to that too, right? Because through all this success and all this cash floating around, buying all this heavy equipment and buying back shares, their bank loan facility is up, their net funded debt is up, their total capital is up, right? So I would like to know what the plan is for some of this debt. Like, I do understand if they're keeping some of it around for tax purposes, but if this is going to go down in the future or if they're going to keep buying back shares. And I mean, their outlook, no surprise here, right, is pretty good. Capital spending in the energy industry has been steadily improving. Commodity prices have risen. I mean, we've seen oil prices go up quite high. They're coming down a little bit recently, but I mean, we're still looking at maybe a $72 barrel of oil, and a rising tide floats all boats. Like, as long as the price of oil, as long as you're bullish on a nice stable price of oil somewhere above probably 65 bucks, this company is going to do just fantastic in the future. It's really hard not to be bullish on this industry. And what we're looking at here is a microcap stock, a penny stock that really not a lot of people are looking at. It's not massively overvalued like a lot of oil and gas stocks. It's kind of one of those fringe oil and gas companies that are really going to benefit from the price of oil, and could be an opportunity. So look, that's enough information, that's enough numbers. Let's get to it, right? What are the red flags? Why would I not invest in Enterprise Group right now? Well, we talked about the revenue being held by two customers. I'm not too worried about that. My bigger worry is this the top of the cycle? You could see I ran their revenue and expenses all the way back here to 2012. They have been higher before, right? They've come down with the price of oil. So you do have to wonder, is this the time? Is this the time when the company is going to continue their upward growth thanks to new innovations? Or are they basically at the top because we're really high in the oil price cycle right now, right? That's something we have to think about. This company also has some debt. They're carrying some debt and they're adding to the debt. So I have a couple questions there. So the main thing when you combine those two things, is the valuation too high? Because the only red here on my page is that the price to earnings is higher than it has been on average. The price to forward cash flow is higher than it's been on average. So I do not mind buying a company when it's going up. I like buying winners. I like buying companies that are going up and that will continue to make me money. I do have to ask the question though, is this the top? I would like to be convinced that this company will continue to grow. But if they can do that, what are the green flags? Why would I invest in Enterprise Group today? There's so much to like here, right? Look at the growth, revenue increasing, gross profit increasing, operating income increasing, net income increasing, improving margins. They're reinvesting into themselves. They've got innovative products. They got 4 revenue streams. They're cash positive. Everything we're looking for in a company these days, right? Good growth, fantastic growth, management decisions provide a lot of return on invested capital. They keep reinvesting that capital. Just, I mean, come on, come on. This is a really interesting company that I think a lot of people are interested in recently. This is their share price going up, right? Still though, even though they're a little bit, high right now, price has been going up. What are we looking at here? I'm looking at a company today that has a trailing PDE of 9.38, a price to sales of 1.29, price to book of 1.01, enterprise value over revenue of 1.74, enterprise value over EBITDA of 5. None of these numbers are massively overvalued. This share price had to come up in price to become fair value. Probably not even at fair value yet, right? So look, as long as Enterprise Group can continue this growth, continue with their innovative products, continue taking advantage of this, oil and gas market that could continue to boom, this is a really, really, really interesting stock. It's going very high up my watch list. You've been watching Common Sense Investing. My name is Cameron. As always, thank you for your time.